Is Microsoft about to become the king of AI? Because after this latest earnings report, it's looking more and more like they're leaving the competition in the dust. Forget the idea that tech spending is slowing down. Microsoft just delivered one of its strongest quarters in years, and it wasn't just Azure. Every single business segment beat expectations. Revenue came in 2% above consensus. And that's not easy when you're already a $3 trillion company. Azure alone grew 35% in constant currency. That's a 4-point acceleration from last quarter. And here's the kicker, Azure AI contributed 16 percentage points to that growth. But the surprise? Core Azure also accelerated. That means GenAI isn't cannibalizing older cloud workloads, it's stacking on top. This is what the bulls mean when they talk about the and equation. It's not GenAI or core cloud. It's GenAI and core cloud. Operating margins jumped 110 basis points year over year. EPS beat by 7%, landing at $3.46. Free cash flow looks like it's heading for a rebound in FY26, with 16% YoY growth even on conservative estimates. So what's driving this? Well, for one thing, Microsoft isn't seeing any macro impact on demand. CFO Amy Hood was clear. Demand across commercial businesses, LinkedIn, gaming, and search has remained strong through April. That's despite what every CIO survey is telling us about tightening IT budgets. Even with rising macro uncertainty, Microsoft's positioning lets them win wallet share, especially as businesses look to consolidate spending. Satya Nadella summed it up best. He said, "Software is the most valuable resource to fight inflation or growth pressure when you need to do more with less." That's exactly what Microsoft is offering. But let's talk about the elephant in the room, Azure's durability. Last quarter, core Azure growth slowed, and investors started asking, is GenAI growth coming at the expense of traditional cloud? But Q3 answered that question loud and clear. Azure growth jumped to 35%, and core Azure re-accelerated from 19% to 21%. Azure AI's growth is estimated at over 215% year over year. And that guidance? Azure is expected to maintain 34 to 35% growth next quarter, far above the 30% whisper number on the street. Even better, this isn't just a bounce in their scale motion business. Enterprise cloud demand is ramping too. Microsoft still sees a supply-demand imbalance going into the June quarter, which suggests demand is hot. Now, let's follow the money, capex. Microsoft spent $21.4 billion in Q3, slightly below target but still massive. For the full year, they expect around $45.2 billion in capex, up 58% YoY. And here's what's interesting. They're shifting spending away from long-term assets like land and buildings, and toward short-duration server equipment. That's a clear signal that cloud demand is accelerating. And it gets better. Commercial RPO, remaining performance obligation, is now $315 billion, up 33%. That's future revenue, already committed. Bookings are also expected to grow in Q4 despite tough comparisons. Add all of that together, durable Azure growth, strategic capex, and strong forward bookings, and you've got a monster setup going into FY26. We're forecasting 31% Azure growth for FY26. Even if capex growth slows down, Microsoft looks on track to deliver strong free cash flow and margin expansion. And don't forget, headcount only grew 2% YoY and actually declined in Q3. That's real cost discipline. So here's the big question everyone's asking. Is this just a relief rally? Or is Microsoft finally stepping into a new era of dominance in AI and cloud? From what we're seeing, this isn't hype anymore. It's real growth, real usage, and real money. If you want to keep up with the companies leading the AI revolution, this is where it's all happening. Don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss a deep dive like this. Thanks for watching, see you in the next one.